Okay, hi there. In this short video, we're going to take a look at 5 arguments for the Bank of England increasing interest rates from their current very low level, and 5 counter arguments making the case perhaps for an interest rate cut rather than an increase. And we'll also look at a range of updated macroeconomic indicators. So policy rates in the UK have been below 1% since 2009, which was a year of recession for the UK economy. The latest Bank of England Monetary Policy Committee vote in January of 2020 voted by 7-2 to leave interest rates at their current level of 0.75%. 2 members of the MPC voted for a rate cut. Not one single economist voted for a rate increase. So how much longer can this period of ultra low interest rates be justified on macroeconomic grounds? Is the new normal for interest rates much lower than the kind of 4 to 6% range we see in the years preceding the global financial crisis? The Bank of England's Monetary Policy Report in January had a useful quote. Over the past decade, our economy, the UK economy, has needed interest rates to remain to stay very low. Are those justifications still in place? Well, here are 5 arguments favouring the Bank of England starting the process of gradually lifting interest rates from their current level. The first is that some of the Brexit uncertainty, which pervaded the UK from 2016 through to the end of 2019, is now lifting. The UK is in a transition period ahead of full departure from the European Union. Business and consumer confidence has taken an improvement. Perhaps the economy can now sustain a slightly higher level of interest rates given this rise in animal spirits. Another argument, second point, is that fiscal policy at the moment is likely to be loosened by the new government and the new Chancellor. There are hints that the government may loosen or relax their current rules on borrowing money to fund infrastructure projects. If fiscal policy is likely to become more expansionary, perhaps, I emphasise that word, perhaps monetary policy can act as a kind of counterbalance to risk excess aggregate demand. The third point for perhaps increasing interest rates is that the UK labour market is very strong. Wages are rising by more than 3% a year, wages and earnings. Unemployment is low, and interest rates really should normally be higher than 0.75% at this stage of the economic cycle, more than 10 years since the last recession. A housing market could be used as a part justification for increasing interest rates, perhaps to increase the cost of a mortgage and help bring about an improvement in housing affordability, to take a lid off, just put a lid on house price inflation, particularly for millions of people who are struggling to find any kind of affordable property to buy or rent. And the fifth argument is really a kind of forward-looking view, which is the argument that if we don't increase interest rates now, perhaps towards, let's say, 1.5%, 2%, with the economy still growing, then there's going to be less scope to cut interest rates again in the next economic downturn. You need some latitude, some scope for cutting interest rates if and when the next recession arrives. Unemployment is low, 45-year low in fact, 3.7% of the labour force registered as out of work but actively seeking a job. That chart shows the kind of long-term historical sweep of unemployment. And house prices have risen strongly in recent years. The gap between England, shown here in blue, Wales, Scotland and Northern Ireland has clearly widened. Okay, so those were points arguing for perhaps for interest rates to go up. What about the counter arguments for saying no, leave them as they are, or in fact even consider an interest rate decrease? The first point I'd like to make is that growth in the UK is slowing down. Real GDP grew by only 1.1% in the last 4 quarters, and an increase in interest rates now could risk causing a widely based downturn, even when inflation actually is below the 2% target. Manufacturing is close to recession. Output fell by over 1% in the last quarter. The risk here is that if interest rates go up, the exchange rate might start to appreciate, caused by an inflow of hot money, and that could cause a deterioration in our trade balance and also put some more export jobs at risk. Rising interest rates could make millions of people very vulnerable because they have a high level of debt, particularly unsecured debt. And we need to make progress in cutting debt levels perhaps before we start raising the cost of borrowing. The fourth point is that although unemployment is low, 3.7, 3.8% of the labour force is the figures you take into the exam. Although unemployment is low, actually real wages, that's nominal wages adjusted for inflation, they've only literally just recovered from the level they were at in 2008 before the global financial crisis. So there is no real wage inflation and pressure in the UK, and there remains a high level of underemployment. Something like 2 million people are registered or estimated to be underemployed. The fifth point, I think, is this kind of contemporary point. I'm sure you're following this issue very closely. We're starting to think more deeply about the wider impact of the coronavirus on the world economy, and there are big uncertainties about the global effect of the coronavirus, particularly fears of global supply chains being disrupted, global trade taking a hit, labour movement being restricted, tourism taking a big hit. So perhaps there are fears of a global recession, in which case central banks might be prepared to cut interest rates as a policy response. If growth stays weak, said the Bank of England a few weeks ago, if growth stays weak, interest rates could fall. Well, if you follow the red line here, this is the quarter-on-quarter growth rate of the economy, then it does seem to be the case that the growth rate in the UK is closer to 1% than 2%. So this is not the time perhaps to raise interest rates. And inflation, it moves up and down from month to month, as I'm sure you know. The orange line there shows the inflation target. There's no obvious signs that inflation in the UK is rampant and heading out of control. In fact, inflation for the last 6-9 months or so has been below the 2% target. And the wider issue, I suppose, is what's happening in the global economy. Two headlines here from the New York Times and Dr. Tom Frieden, that there are estimates that the COVID-19 virus could cost the global economy more than $1 trillion. It's clearly a negative demand and supply shock on the world economy. And so the likelihood is, I think, at the moment, that interest rates in the UK will probably go down before they start going up again. Okay, thank you very much indeed.